Let's start with the bank that everybody is talking about right now. HSBC. It came out in the news lately that they are cutting 35,000 jobs. They took a $7.3 billion write-down, which they call a goodwill impairment. You may be asking yourself, George, what on earth is a goodwill impairment? That's when you go out and buy a home in 2006 for $1 million. And then in 2009, you realize, whoops, that house is worth about $50,000. The difference between the $1 million that you paid for it and the $50,000 that your house is actually worth is a goodwill impairment. $4.65 billion loss just in Europe. And I want to point out that HSBC has all their eggs in one basket. What I mean by that, 50% of their revenue comes from Asia, and Asia represents 90% of their total pre-tax profit. Insert the, which of course I cannot say, or this YouTube video will be. So we'll call it the cerveza sickness. China is the starting point for the majority of the supply chains throughout the world. So manufacturer A supplies parts to a corporation, we'll call that corporation B in India, which uses those parts to create an end product. Likewise with corporation C in Europe. HSBC might have loans to all three of these corporations on their balance sheet. If something goes haywire, like the cerveza sickness in China, and shuts everything down right here, that means that Indian corporation and the European corporation aren't going to be able to pay back their loans. That creates this Jenga style balance sheet for HSBC, where if that bottom block, which is China, goes, the entire thing comes crashing down along with all of HSBC's revenue, or at least 90% of their profit. Unfortunately, it gets worse. HSBC's operating expenses were up by 22% to $42 billion. Try working off that net sometime. Also, they took an $883 million expected credit loss in Q3 of 2019. Why was that? Because of the Hong Kong protests. So if they took an $883 million loss, how big of a loss are they going to have to take now with the cerveza sickness global pandemic shutting down their entire revenue source? Also, let's not forget that 32% of their entire revenue is just in Hong Kong, mostly real estate and adjustable rate mortgages that adjust every single month. So what happens when those interest rates increase by something like losing the peg to the dollar? And if you think that's crazy talk, make sure you watch my video on Kyle Bass and HSBC from last week. We'll put a link in the description below. Oh, but wait, there is more. Do you have any money in the GLD, the gold ETF? I hope not, because HSBC is the custodian for all of that physical gold that is supposed to back up all of this paper gold. To explore that further, let's go right back to one of my videos on the GLD. HSBC right now is the #1 borrower in the repo market of all things. And if you don't know what I'm talking about, go check out my videos on the repo market right now. This is staggering that HSBC, the #1 borrower in the repo market, is in charge of your gold if you own the GLD ETF. Let me take it one step further and give you some background on HSBC. Fined $1.2 billion for violating laws designed to prevent money laundering or other illegal financial activity. Allowed drug traffickers to launder billions of dollars in the United States. Admitted gross violations of the Bank Secrecy Act, which involved laundering over $881 million, paid a $275 million penalty to settle with the Commodity Futures Trading Commission for manipulation, fined $470 million for abusive mortgage practices during the 2008 crisis, faces criminal investigations in US, France, Belgium, and Argentina. So that is the custodian of your gold if you own the GLD. Good luck with that. Step number 2. Many of the banks are becoming structurally unprofitable. And it all starts with the yield curve. Central banks come in, they try to flatten out that long end of the yield curve to get interest rates low. They think that will stimulate more consumer borrowing, therefore more consumer spending, and a better economy. That's the way the Keynesian mind thinks. But the banking business model is based on borrowing short, lending long, and pocketing the spread. In other words, if we have a yield curve right here, 3-month, 1-year, 10-year, 30-year, interest rates going from 0 all the way up to 6%, if they're borrowing, they meaning the banks, if they are borrowing money at this point, they are receiving money at this point. So they're borrowing here, they're lending here. So this is their expense, this is their revenue. It gets really simple from there. If they have a normal free market yield curve where interest rates, shorter term, are lower than they are long term, we have this gradually sloping up. That means banks are paying this much and they're receiving more than they pay. That's what we want. When the central banks flatten out that yield curve, there's no more profit opportunity because they are having to pay the same amount that they are receiving for initiating that loan. It gets even worse if the yield curve is inverted. Then they're paying more than they're actually receiving. I want to take this a step further and break it down into a language that even the central bankers and politicians can understand. And as we know, they're not the sharpest tools in the shed. But they love the George Gaiman channel, so I know they're watching right now. So for all the central bankers and politicians, this is for you. In a gradually upsloping yield curve that's produced by the free market and a fixed currency supply, this is good. In a flat yield curve produced by quantitative easing in the central banks, this is bad. And in an inverted yield curve, all the banks go bust, and this is horrible. But the yield curve is the least of the bank's concerns. Let's talk about negative interest rates. A bank balance sheet, as we know, has assets and liabilities. The central bank comes in and drops interest rates negative, and that turns the entire asset side of their balance sheet that used to produce the revenue, it turns it into an expense. They have to pay to initiate loans, and they have to pay for the reserves held with the central bank. So all the assets produce an expense, and all the liabilities produce an expense. When you have 100% expenses and 0% revenue, that means you are going bust very fast. But I have good news. Hashtag sarcasm. There is a way out for the banks, and that's if they just go further out the risk curve. As an example of this, we'll look at Japanese banks. They have all these excess reserves because so many people have deposits with the banks, and their reserve requirements are most likely very low. But they can't really make any loans because they've pulled so much demand forward from the future by having artificially low interest rates for the last 2 decades. What I mean by that is who is going to run out and get a loan right now because the interest rate has gone from 0.2% to 0.1%? Probably no one. Also, their demographics. Everyone is over 100 years old in Japan. And because the negative rates have been there so long, it's produced an environment where no one wants to spend money because no one can afford to spend money because they can't get a return on their investments. So ironically, they end up spending less, saving more, and taking out less debt. To understand how the Japanese banks have got around the problem of having a structurally unprofitable business model, let's go right to the Financial Times. Bankers are looking at relentless declines in their income, leaving dozens of teetering institutions with an incentive to gamble on risky property loans or exotic investments overseas. Holding more than $3 trillion in assets, Japan's regional lenders are bigger than the Italian banking system, and their excess deposits make them a crucial buyer of everything from collateralized loan obligations in the US, that sounds safe, more on that later, to covered mortgage bonds in Denmark. So what are collateralized loan obligations, or CLOs? Well, this is a really neat piece of financial engineering. What they do is they take all of these loans and bundle them together, and then they divide them into separate tranches based on the risk. So as we go down, the risk and your return increases. And where have we seen that before? My point is that if the yield curve doesn't get the banks, negative interest rates most likely will. And if they can somehow escape negative interest rates, they'll be pushed so far out the risk curve just to try to eke out a small profit. The next recession will definitely put them out of business. Step number 3, the U bailout. This is how you will bail out the banks and how you're already bailing them out right now. Starts with the central bank flattening out that yield curve. Your bank is right here and they can't make a dime on the retail side. They need that traditional upsloping yield curve. So here you are right here. You're very apprehensive, as you can tell, because you know the banks are going to pull out some tricks in order to get into your back pocket. First, it starts with credit card interest rate and miscellaneous fees. You guys know as well as I do the nickel and dime fees that they are charging you on your checking account, and your savings account just keeps going up and up and up. And let's look at credit card interest rates. Going back to 1995, those rates were 15.28%. Compare that with a Fed funds rate that's 6%. Editor, let's go ahead and throw up this chart. Fast forward to 2003, rates are 11.96%, but the Fed funds rate is down to 1.25%. That makes a little sense. But now, credit card rates are at 16.96% at a 25-year high, even though Fed funds rate is still only 1.55%. To explore this further, let's go right to a full-length interview I had with my good buddy who's got the best personal finance channel on all of YouTube. His name is Marco with Whiteboard Finance. You're talking about credit card debt. And one thing that is really caught my attention, this was a couple months ago, I did a video on this, and I really didn't take a deep dive, but I noticed that interest rates have gone so low. I mean, for a 10, 12-year period there, we had ZIRP, 0% interest rate policy. But credit card interest rates have not come down. In fact, correct me if I'm wrong, I think they've actually gone up. Do you have any insight as to why that may be?
I have no idea. I think it's because it's one of the most profitable items for a bank, the credit cards, and they're not making any money on the retail side. And I know the exact chart you're referencing. you have ZERP, and then you have APRs on credit cards, which has been through the roof. You would think that they'd be more correlated or in line, but they're not. They're almost inverse, if you will. I think it's because credit cards are one of the most profitable devices for a regular bank or for a lending institution, that they just need to make money somehow, because they're not making on the retail side, that's for sure. And you're starting to see more and more branches, physical branches, closing of these Chases, these PNCs, or whatever region you're in. Wells Fargo, for example.
You may be saying to yourself, yeah, George, that's no big deal, even if they charge me a little bit more on my credit card, because they'll be paying me to take out huge loans like a mortgage. And man, that'll be amazing. Not so fast. Editor, let's throw up the article. Danish bank launches world's first negative interest rate mortgage. Under its negative mortgage, borrowers will make a monthly repayment as usual, but the amount still outstanding will be reduced each month by more than the borrower paid. Sounds pretty good so far. But when we go to the bottom of the article, we see a different story. In reality, the borrower in Denmark is likely to end up paying back more than they borrowed, just like a traditional loan, because there are still fees and charges to compensate the bank for arranging the deal. So yes, you may be able to get a negative interest rate mortgage, but because they nickel and dime you so much with these fees, you'll most likely end up paying the same, if not more, than you would with a normal positive interest rate loan. And although you're currently bailing them out with the astronomical credit card interest rates and all of the nickel and dime fees that they're charging you, they still can go bust. And if that happens, it's actually a pretty simple solution. They just do a Cyprus type bail-in, where they literally go into your bank account and steal your money, or we just get a good old-fashioned taxpayer bailout like we did in 2009. And in that case, you actually wouldn't be bailing out the banks. It would be your kids and your grandkids. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.